silver hit $121 per ounce. Then it crashed 40% in days. Then it held the floor 3 times. China quietly imported 790 tons of silver in just 2 months. And the global market has now run a deficit every single year for the past 5 years straight. Something is happening in silver, and it is not what most people think it is. The number that matters most right now is not the spot price. It is 67 million ounces. That is the supply shortfall the Silver Institute, working with London-based consultancy Metals Focus, is projecting for 2026, the 6th consecutive annual deficit in the silver market. 6 years. That means for 6 years running, the world has consumed more silver than it has produced. The cumulative damage from those 5 years prior already exceeds 800 million ounces, roughly the equivalent of 1 full year of global mining output, now simply gone from above-ground reserves. The 6th year is not an outlier. It is a confirmation. Think about that for a moment. 800 million ounces drawn down over 5 years, and the mining industry cannot simply turn a tap. Silver is primarily a byproduct metal. Roughly 70% of all silver produced each year emerges as a secondary output from copper, gold, zinc, and lead mines. When those miners respond to copper prices or gold prices, silver supply moves as a consequence, not a cause. The world cannot decide to mine more silver the way an oil company decides to drill another well. Supply is structurally inelastic, and demand is not. Here is what the demand side looks like right now. In 2025, global silver demand reached an estimated 1.24 billion ounces. Total supply, mining plus recycling, came in at approximately 1.01 billion ounces. The gap, 230 million ounces. That is not a rounding error. That is the entire annual silver output of Mexico, the world's largest silver producer, vaporized as a deficit in a single year. Industrial applications, solar panels, electric vehicles, electronics, artificial intelligence hardware, now account for more than half of all global silver consumption. These industries do not reduce their orders because silver becomes expensive. They are building infrastructure measured in decades. The demand is locked in. China understood this before the rest of the world did. On the first day of January 2026, Beijing implemented a sweeping new licensing framework for silver exports. The policy is not a tariff, it is a structural restriction. Only 44 pre-approved companies are now permitted to export refined silver. To qualify, a firm must produce at least 80 tons of silver annually and hold credit lines above $30 million. That requirement effectively eliminates hundreds of smaller and mid-sized refiners from international markets overnight. China controls between 60 and 70% of global silver refining capacity. When Beijing decides who can export that metal and who cannot, it does not merely influence the market. It becomes the market's gatekeeper. This mirrors almost exactly the playbook Beijing deployed on rare earth metals. The world was slow to understand the rare earth move. It appears to be slow again here. The physical consequences are already measurable. In the first 2 months of 2026 alone, China imported over 790 tons of silver from abroad, an 8-year high. Nearly 470 tons of that arrived in February, the highest ever recorded for that month, according to Chinese customs data. At the same time, Chinese warehouses are being drawn down. Solar manufacturers are stockpiling metal ahead of an April policy deadline. Retail investors across China are buying bars ranging from 20 grams to 1 kilogram. Rona O'Connell, head of market analysis for EMEA and Asia at StoneX Group, described the industrial buying simply, "Solar cell manufacturers," she said, "are going gangbusters." Strong domestic demand has pushed Shanghai prices well above international benchmarks, at points commanding premiums of $8 per ounce over the London reference price, at a time when Shanghai normally trades at a discount. Meanwhile, the paper market tells a different story, and that divergence may be the most important signal in this entire picture. Rich Chekhan, president and chief operating officer of Asset Strategies International, has noted that the ratio of paper silver contracts to real physical ounces of silver currently stands at 356 to 1. 356 paper promises for every single ounce of metal that actually exists in deliverable form. COMEX registered inventories have declined roughly 70% since 2020. London vault levels have followed a similar trajectory. Some regional markets are operating on 30 to 45 days of usable silver at current consumption rates. What happens when a portion of those 356 paper holders decides they want physical metal instead of a contract? That is not a hypothetical. In early 2026, institutions began converting paper ETF positions into allocated physical holdings, precisely because they have begun asking that question. The price chart captures the tension of all of this in concentrated form. Silver began 2025 at approximately $29 per ounce. By year-end, it had surpassed $70, a gain of roughly 147% in 12 months. In the first 4 weeks of 2026 alone, it surged another 60%, piercing $100 and ultimately reaching an all-time high of $121.62 per ounce. Then came the crash. On January 30th, a Reuters report about potential changes to U.S. strategic metals policy triggered algorithmic selling. Silver fell from $121 to $76 in a single session, its worst trading day since 1980. The metal subsequently stabilized, then cracked again in February and again in mid-March. Each time, it found support near the $70 zone. As of the most recent session, silver trades near $68 per ounce, still more than double its price 1 year ago, but deeply inside a consolidation that has now tested the same floor 3 times without breaking it. Greg Shearer, head of metal strategy at J.P. Morgan Global Research, has framed the relationship between gold and silver plainly. They trade in sharp correlation, and to understand silver price formation, you must first understand that gold, now trading above $5,000 per ounce, has provided the foundation. J.P. Morgan sees silver averaging $81 per ounce in 2026. Bank of America's metals analyst Michael Widmer takes a considerably wider view, projecting a range of $135 to $309 per ounce by year-end, depending on how far the gold-to-silver ratio compresses from its current level near 65 to 1. Alan Hibbard, lead analyst at Gold Silver, put his expectation plainly. He would not be surprised to see silver increase by over $100 per ounce from current levels, targeting a price above $175. These forecasts span an enormous range. What they share is a common structural diagnosis. Supply cannot keep pace with demand, and the deficit is not closing. The picture that emerges from all of this is not complicated, even if the mechanics are. A market that has been in deficit for 6 consecutive years. A dominant refining power that has reclassified silver as a strategic material and restricted its export to a licensed few. A physical-to-paper ratio of 356 to 1 that raises serious questions about what happens when delivery is actually demanded. And a price that has already more than doubled in 12 months, crashed violently, and is now consolidating at a floor that buyers have defended 3 times. The speculative excess of January has been cleared out. What remains underneath it are the structural forces, the deficit, the export controls, the industrial demand, the paper market fragility that drove silver to those heights in the first place. Those forces did not reverse when the price did. The crash was not the end of the silver story. It was the reset that revealed which part of the story was real.